Now, the reason that people like dividend income is because you have a check coming in. And we all love certainty. That's just the way we are as people. When I remember studying economics in college, and they would ask you, hey, would you rather get paid once a year, once a month, or once a week? And the truth is, we would all pick once a week. It just feels better. I don't have to do as much planning, I don't have to overthink anything. I know that if I mess up this week, I'm going to get money next week and I can fix it and try again. When you get paid once a month, you have to really figure out how to allocate the money so that you don't run out of it. This is the struggle that a lot of people face when it comes to retirement. Hi, it's Dre Griggs with Obsidian Wisdom. Today we'll be answering the question, how do I invest in dividend stocks for passive income? As you all are well aware, there are 7 streams of income, and I talk about them all the time. And the reason is very important. The IRS says that 65% of self-made millionaires have at least 3 streams of income. If you have a good dividend investing strategy, that would be considered investment income. And that's just the dividends that are paid out. So that would be one stream. If you take your active income or your earned income or profits from your business and invest in dividends, you have now created 2 streams. Now, based on the strategy that I'm going to discuss with you today, if you find great companies to invest in that appreciate in value, you already now have 3 streams of income. So you could follow this strategy to build the income that you need. You would have your earned income, then you would have your capital gains from the appreciation of your investments, as long as you keep them over a year and a day. And then you have the investment income, which would be the dividend income in this place. And then you're set. If you have a business, it will be profits from your business that you would then invest in these stocks. And then you would have the capital gains and the investment income. So you would have the 3 streams as well. Now, the reason that people like dividend income is because you have a check coming in. And we all love certainty. That's just the way we are as people. When I remember studying economics in college, and they would ask you, hey, would you rather get paid once a year, once a month, or once a week? And the truth is, we would all pick once a week. It just feels better. I don't have to do as much planning. I don't have to overthink anything. I know that if I mess up this week, I'm going to get money next week and I can fix it and try again. When you get paid once a month, you have to really figure out how to allocate the money so that you don't run out of it. This is the struggle that a lot of people face when it comes to retirement. They're not 100% sure how to take the money that they have and create an income. As a result, dividend income sounds like a great strategy to have the comfort and security that you normally had with a consistent stream of revenue. So when it comes to you being able to invest, and I'll link a video to the top 10 buy and hold forever dividend stocks that I just did a video on recently. But when you are saying, I'm going to have this investment strategy, one of the things that they often talk about is how healthy is the company? Am I getting trapped with a company that knows that all I'm going to do is look for companies that pay out dividends, which I don't recommend you doing. But when people do that, then the company will say, okay, we have a huge dividend. Look at how much we're paying out. And then you, if you're just looking at dividends, you'll say, well, this is great. I'm going to go put my money over there. And the way that we keep from getting trapped is we look at something called the payout ratio, which is just saying, what is my annualized dividend per share divided by the current calendar year's earnings per share? That lets me know how much money that company is making and how much they're giving to me as a silent business partner, because that is what we are as investors. When we buy stocks in a company, we are a business partner. But since we don't run the day-to-day operations, it'll be more like we're the silent business partner. We give them the money, they make that money grow. And so you don't want to invest in a company that has a certain payout ratio. And we'll go through some healthy ones and some unhealthy ones. Normally, if you're in that 0 to 35%, that's considered a good dividend payout ratio, to where about 0 to 35% of the earnings per share per any given year is what they pay out to the owners of the company. You as a stockholder would be an earner. If you're in that 0 to 35%, then you would say, okay, I feel pretty good. This company, they're still reinvesting 65% of their earnings, so they can still grow, they can still go into research and development, they can still increase their market share, they can still appreciate the overall value of the company, which is my other revenue stream. And so I'm okay with that. That feels pretty good. You would consider it to be a healthy range to be in that 35 to 55%, like 30 to 60%. If a company is taking about 30 or 60% of the revenue that is generating or the earnings it's generating and is giving it back to you, hopefully this is what we would call a blue chip company, which just means it's more of the larger company. So this could be like your AT&Ts, where the idea is they already have a pretty solid market share and they don't really need to invest in any more commercials. They have really good name ID. Everybody's really comfortable with that company. So it just makes sense for them to give that money back to you as the silent business partner. If they were able to reinvest the money and grow further, they would. But there's not much opportunity for them. And that's realistic and that's fine as long as it is a fully grown, high market share, blue chip company. These are normally going to be companies that probably have revenues or capitalization at probably at least at I'd say like $10 billion, whereas at least $10 billion and higher, you would consider those normally blue chip. With inflation, the number kind of keeps trickling up, but 10 billion and higher is probably pretty good, where you'll say, all right, this is a stable company. It's been around for a long time. They have good market share. They have good name ID. They're giving me 35 to 55%, 30 to 60% of the earnings, and they're giving it back to the business owners. That is okay in that type of a scenario. When you get into that 30 to 60% and the company doesn't have a lot of market share, then you should have your antennas raised, where you're thinking, couldn't they use this money to expand and to grow? Couldn't they reinvest this money to increase the value of the company, which also increases the money that I make as a business owner? And if that's the case, then normally I would say, okay, I'm going to be cautious about this. I don't like a company that's giving me back more than 50% of its earnings and it's not reinvesting and trying to grow. What would be considered a high payout ratio would be really, we're in that 55 to 75%. Once you start getting over 50%, I've already told you, you should be very cautious of the company as a whole. But anybody that's giving about 75% of its earnings is a very high payout ratio. So every time, so basically the company makes $100 and then they give you 75 of the $100. That only leaves the company with $25 left of earnings. What is it really going to do with that? We're not able to really invest in research and development. We're not really able to expand our market share. We're not really able to try to make this company better and be agile, because the market is always shifting. It's always adapting. And as a result, I personally would stay away from a company that's giving out 75%. As much as we like dividend income, as much as that would be a beneficial payout for you, it means that the amount of money that you have to generate to make the income that you want is much smaller. Then I'll go over that a little bit later in the video. It doesn't change the fact that we're looking for long-term healthy investments. And that just sounds like a trap. It really does. And then naturally, anything over that, now we're just getting crazy. Now, there are companies out there that have a payout ratio more than the earnings per share, where they're giving out 100% of the earnings. So they make $100 and they give you $100 every year. There's companies out there that make $100 and are giving you $150. But that should be a red flag. You should run away from anybody that's paying out that high of a dividend ratio, because you know that the reason they're doing that is to bring you in as the investor. It's unlikely that they could give you that return year after year. And if they can't give it to you year after year, then why are you investing in it if you're focused on dividend investing? Now, if you love the company and then you want to invest in it, well, that's a different set of measurements. But I would say, just on the outside looking in, if I'm looking at management and they're paying out $150 for every $100 they make, that sounds like a short-term strategy just on the surface, which is not a good sign for how they're operating and how they're making decisions. They know that what they're doing is not sustainable, but they're just trying to get the extra revenue, get the buzz. And I'm not a fan of someone that has to resort to such gimmicks to get attention and to get people to invest in the company, knowing that they're going to basically perform a bait and switch. I mean, naturally, they will tell you dividends aren't promised. So it's not a true bait and switch, but they do know that people are going to just look in the stock market and say highest dividend payout ratios, and then they're going to invest in those companies. And those companies are going to catch them, and then once they catch them, they're not going to pay a dividend probably in 5 years. And so I don't like those short-term strategies, so that's just something for me. Now, I did promise you guys that I would go over some of the percentages of how to determine what makes the most sense for you. And the thing about it is, it's kind of hard. So the average dividend yield is about 2% in the stock market, but naturally that range also captures companies that aren't paying a dividend, right? So it's the average of the stock market, but then there's companies that don't pay it. But with that being said, the yield will determine how much of an income you need. So, for example, if you have a yield of 6%, then you wanted $2,000 per month, you would only need to have $400,000 invested. If you have $400,000 invested, you have the 6% yield, that would be $24,000 in a year, and so that would be $2,000 a month. If the yield was to decrease to 4%, which I have like a little calculator that I'm gonna be able to change it, that 400,000 would then only give you $1,300 a month, so 1,333 to be exact. So that's a $500 per month decrease because the yield had decreased from that 4% or from the 6% to the 4%. Now, if you just were to take what is the average of all of the stock market in the S&P and say 2%, then if you wanted to be able to generate that 1,800 a month or the 2,000 months around there, you'll need $1.1 million to be able to generate a consistent like $1,800 a month around that 2% mark. And so you can see that the yield, that's why a lot of people get trapped in it, because depending on how much the yield is determines how much they're paying you back, and then that is determining how much income you're getting on a monthly basis. But you want to build a long-term portfolio to where you're investing in the stock market on a regular basis. You're getting these companies that are great companies at a good price, ideally, but you understand that it's a great company and maybe there is some wiggle room where you're able to calculate the dividends and then the company's growth and the opportunity and say, well, I can work a little bit. Now, I'm not telling you to go and get a company with a PE ratio of like 500, right? We're not trying to buy a dividend, but I am saying that there may be some wiggle room in your investment strategy where you say, if this happens, then I will allow myself to expand. And the reason I say it that way is because you want to stick to whatever your investment strategy is, whether you're talking about dividends, whether you're talking about purchasing stocks, whether you're talking about selling stocks. What is the metrics that you will use to determine what made a good stock to purchase? And then when those metrics change, what do you do? Do you sell them? Do you hold and think about it? Do you watch it to see? You need to have these things laid out in place. Otherwise, you'll find yourself buying high and selling low as you're chasing the returns and fads on the TV. And that doesn't work for anyone over the long term.